A wedge is a price pattern marked by converging trend lines on a price chart. In order to draw the pattern, two trend lines are used to connect the highs and lows of a price, which give the appearance of a wedge as the lines approach a convergence. In technical analysis, the wedge pattern is regarded as a useful indicator of a potential reversal in price movement. The rising wedge pattern appears when a trend line is caught in the middle of two upwardly slanted lines of support and resistance. This pattern tends to indicate that an instrument price will decline once it breaks the support level. Once the rising wedge is identified, traders can enter the market by placing a sell order on the break of the bottom side of the wedge. In order to avoid false breakouts, traders should wait for a candle to close below the bottom trend line before entering. Place the stop loss above the top side of the rising wedge, and the take profit is placed by taking the height of the back of the wedge and by extending that distance down from the trend line breakout. A falling wedge is formed between two downwardly sloping levels. The line of resistance is steeper than the support, and this pattern generally signals that the price of an instrument will eventually rise when it breaks through the resistance level. Once the falling wedge is identified, traders can enter the market by placing a buy order on the break of the top side of the wedge. In order to avoid false breakouts, traders should wait for a candle to close above the top trend line before entering. Place the stop loss below the bottom side of the falling wedge, and the take profit is placed by taking the height of the back of the wedge and by extending that distance up from the trend line breakout.